Hello, everyone, and welcome. We are Kevin Rucker and Stephen Seewer and are financial consultants with Alliant Retirement and Investment Services. Our team at Alliant Retirement and Investment Services is focused on helping you understand the ins and outs of investing, saving for retirement, and much more. Take a look at our website, ARIS.Alliant at AlliantCreditUnion.com to see our list of weekly webinars, our podcast, Invest Savvy, our blog, and other financial resources. Today, we are going to discuss the emotions and economics of investing. Let's review the agenda. We'll be covering 3 scenarios involving emotions, expectations, and economics. First, we'll discuss how fear, the media, and the urge to time the markets influence investors' emotions. Second, we'll explore investors' expectations during bull markets and their predispositions to think, this time it's different. We'll also look at 3 types of investors and their market expectations. Third, we'll present a brief overview of U.S. economic history by touring the last 8 decades. We want to capture your attention while focusing on emotions. So many investors struggle with removing emotion from decisions about their investments, overestimating their ability to deal with periods of market decline and volatility. We can see in the illustration here that while the S&P 500 index grew on average 12.56% per year over the 10 years ending December 31st, 2022, the average equity fund investor during the same period earned an average annual return of just 9.33%. One reason for this may be that some investors jumped in and out of the market based on short-term shifts and, in the process, missed out on longer-term opportunities. Fear, and the main idea here that the majority of investors are not comfortable with higher levels of investment risk. This may come as a surprise. For the majority of investors, fear seems to be the greatest motivator. Loss aversion studies have found that people place about twice the value on giving up an item than on receiving the same item. Unfortunately, sometimes people don't recognize this motivation in themselves. If they did, we probably would have seen better results on the slide outlining the differences between market returns and the average equity investor's return.
And one thing that can influence our decisions is certainly the media. Some investors have been motivated to withdraw their money from their investments based on fear or the influence of events and the way they're portrayed in the media. Imagine the reaction many investors had when they read the first headline, Panic Hammers Market. Now look at another headline from the very same day, Stocks Bounce Back. Basing investment decisions on events broadcast by the media may not be the best method for managing your finances. And the new media looks a lot like the old media. Take a look at some of these headlines around COVID. Stock market plummets, wild swings, stocks plunge, bear market, meltdown. It's really no difference. Anywhere you go on the web, you're going to see sensationalized representation of market events. Let's discuss the drawbacks of maybe timing the market. When people get nervous with wild headlines like this, sometimes they'll try to get out and get back in at a later date. Market timing is that. It may be risky. Investors who may want to attempt timing the market are trying to essentially predict the future, which of course is impossible. These investors think about missing the worst days, but what if they miss the best days instead? This chart shows what would happen if an investor tried to time the market, but missed the best 10, 20, 30, or even 40 trading days. The best trading days are based on gains as measured by the S&P 500 over the 20-year period that ended in December 23. As you can see on the chart, staying fully invested returned 9.69%. That's pretty close to historical long-term averages. But if you missed the best 10 days, it's about half that, 5.5%. And the best 20 days, and your returns are devastated. So timing the market, it's better to have time in the market rather than timing the market. This is another way of looking at the same information, but in dollars. And this is showing us that if you stayed in, and this period is from essentially 1980 through the end of the first quarter of 2025, your hypothetical investment here would have grown to $1.6 million. That's $10,000 to $1.6 million. But if you miss the best 5 days, you knock off about $635,000. The best 10 days, you're down to 730. And if you miss the best 50 days, it's essentially savings account interest. Earned almost nothing. All right. And then the probability of positive returns. This is super important. The stock market, of course, has some investment risk. It goes up and down. But the thing you should always remember is that the longer you stay in, the more likely it is you're going to have a good result. So you can see here that if you're in one day, it's sort of a flip of the coin. Some days the market's up, some days it's down, but it's up slightly more days than it is down. You start stretching that out to a year, and suddenly you're at 77% chance of positive returns. And then go out further than that, 3, 5 years, 10 years, it's a very, very high probability that you're going to have a positive outcome. So time is very important, and your time horizon is critical in determining the types of investments we'll place you in. Kevin.
Let's talk about expectations. We want to review how bull markets influence investors' decisions. When the stock market performs well, as it did through most of the 1990s, investors can become, quote unquote, blinded by this euphoria over their investment returns. We usually hope for bull markets and double-digit returns from our investments. The problem is, this expectation tends to blur our memories of bear or declining stock markets. So the 4 most costly words in investing may be, this time it's different. Chances are likely, however, that this time it's not different. Let's look at the history of bear markets. Since 1972, there have been 14 bear markets, roughly one every 4 years. On average, they lasted just under 1 year, and the Dow Jones Industrial Average declined an average of 28%. When we look at the bear markets shown on this slide, we see how frequently they have occurred, suggesting that we will continue to have both bull and bear markets. This chart here is important. It puts some color to what we just looked at in the history of bull and bear markets going back to 1942. We see that the average bull market here in blue lasted 4.3 years with an average cumulative total return of almost 150%. Now, the average bear market, colored here in orange, lasted 11.1 months, much shorter time period, with an average cumulative loss of negative 31.7%. I also want to note here that the gray bars are indicative of a recession. Here we see the average frequency for various types of declines in the market. We went from October 2023 through March 2025 without a decline of more than 10% in the S&P 500. Now, this was just in line with the average. That doesn't always happen, but it's kind of interesting to note that it did during this recent market decline. I believe all of us can benefit from the wisdom of Sir John Templeton, who is Templeton Fund's founder. His investment philosophy is timeless, pointing out how emotions can affect the market and vice versa. Now, let's look at 3 investor types and their expectations of the markets. First, we have the optimist. Now, the stock market run throughout most of the 1990s gave investors good reason to feel euphoric. The bull market of the last 10 years has been fueling optimism as well. Here are a few characteristics of the optimist. They assume the market can only go up. They also think stocks are the only way to go. They expect double-digit annual returns from stocks. Very optimistic ideas. Here is a view of their market. They tend to think that the stock market continually rises, but fails to consider the many short-term fluctuations that have occurred throughout history. Now let's take a look at the skeptic. In contrast, no matter how strong the stock market may be, naysayers are always around. The skeptic can be described as follows. They assume the market will stay flat. They think bonds are the only way to go, and they are often handcuffed by an indecision. The next few slides will further explain the skeptic's characteristics. The skeptic tends to see the stock market as relatively flat or going sideways. The market always has ups and downs, but remains even overall in their ideology. This chart shows the Dow Jones Industrial Average from September 1st, 1967 through August 31st, 1982. During this period, the Dow began and ended at the same point. Our main idea here is that it's these inappropriate expectations that could set up a skeptic for missed opportunities from the stock market. Sometimes investors lose sight of long-term growth opportunities in stocks. Yet, even when you include the effects of the worst bear markets, US stocks have historically provided solid long-term returns on average. Since skeptics believe that bonds are the way to go, they forgo the additional returns that stocks have historically provided. The chart above illustrates how stocks have traditionally outperformed bonds over longer holding periods. Now, of course, all investments involve risk, including possible loss of principal. Stock prices fluctuate, sometimes rapidly and dramatically, due to factors affecting individual companies, particular industries or sectors, or even general market conditions. Bond prices generally move in the opposite direction of interest rates. As interest rates rise, bond prices often decline, and vice versa. Now let's go on to the pessimist. For some people, the fear of incurring a loss is their overwhelming decision-making factor. This would be the pessimist. Rather than deal with any degree of loss, pessimists choose to invest in ways they believe are risk-free. Here are some traits of the pessimist. They think the stock market is too much of a gamble. They think bonds may be better, but even that fluctuation in value scares them. They believe CDs, certificates of deposit, are the only sure way to go. Many pessimists turn to CDs and other FDIC-insured accounts for the safety of principal that they offer. But have they really escaped all investment risk? The pessimist tends to see the stock market as something that will likely go down. This chart shows the Dow Jones Industrial Average during a 33-month period from December 31st, 1999 through September 30th, 2002, when it slid more than 33%. Looking at missing opportunities in the market, and when a pessimist just views one index over a certain period of time and sees a loss, and they want to just go into certificates of deposit, there's a missed opportunity. One thing to remember is that inflation erodes purchasing power over time. All investors should consider inflation's effects on their investments. Unfortunately, investments offering greater safety of principal may be most vulnerable to inflation, since they have generally offered the lowest returns. This chart shows how CDs are subject to inflation risk and how investing in CDs may not provide sufficient growth to meet the pessimist investment objectives. Not only can pessimists lose purchasing power over time, they can miss out on the important potential growth that stocks have historically offered. However, greater inherent risks are involved in investing in stocks. This graph compares the annualized returns of different assets and economic statistics going back to 2007. We can see here that stocks have the highest annualized return. Gold comes into a close second. And I want to highlight here CPI, or the Consumer Price Index, which measures inflation. And if you just stayed invested in cash or short-term certificates of deposit, that's where you see the effects of inflation and erosion of purchasing power. You would have lost 1.2% per year over the last 17 years. Now, the bottom line here is that we've talked about these three different types of investors: the optimist, the skeptic, and the pessimist, and how their expectations and emotions can change with different investment strategies. The optimist thinks that the market will grow to the sky and is overexposed, taking too much risk in equities. The skeptic thinks the market will go sideways and is underweight in equities and may miss out on growth opportunities. The pessimist thinks the market will decline and is not invested in equities at all. While investing in insured financial products, this investor misses growth opportunities and risks eroding purchasing power due to inflation. Now let's take a look at some economic trends. See if you can identify the types of investors we discuss as we look at an overview of US economic history.
All right, so let's talk about a concept called asset allocation. it's the foundation of the way Kevin and I build portfolios for our clients. It's how we allocate risk across a portfolio, and we moderate that risk by adding things like cash or cash equivalents and bonds to an otherwise stock portfolio. You can see here there's 5 hypothetical asset allocation portfolios, from the most aggressive, which is 100% stocks, to a more moderate portfolio at the bottom that would be largely bonds, 60% bonds. There's many ways to allocate your own portfolio among asset classes. Even within the individual asset class of stocks, for instance, there can be many different stock categories to choose from: small, medium, large companies, international stocks, value stocks, growth stocks. There's many different ways you can allocate within each category. To demonstrate the history of the stock market, we'll follow the performance of these 5 hypothetical asset allocation portfolios through the decades. So the first one here is the 1930s, and that was, of course, the Great Depression. In 1933, the Depression hit bottom, and at that time, nearly a quarter of the civilian labor force was unemployed. And in 1935, Social Security was passed. Over the entire decade, stocks had essentially no performance. It was almost zero for the decade. Long-term government bonds returned just shy of 5%. And shockingly, unemployment averaged 18% for the decade. Moving on to the 1940s, this decade was, of course, marked by World War II, following Japan's attack on Pearl Harbor in 1941. The entire economy shifted to a war production economy at that point. And then in 1945, we reconverted back to civilian production. We had a wave of price increases and labor strikes, and some of the government controls that were put in place over the wartime were lifted. But over the decade, stocks returned about 9.17% per year, government bonds about 3.25%, and T-bills or cash less than 1%, about 0.4%. And unemployment had come down to an average of about 5%. In the 1950s, these were the years marked by President Eisenhower. And in 1954, the stock market reached its highest level since the great crash of 1929. In 1957, we had a bear market that lasted about 18 months and ended in October. And the Dow Jones declined 19.4% during that market move. And in 1958, we had a recession that left 5 million Americans out of work. But the stock market did pretty well. It returned 19.35% per year over the decade. That's almost twice the long-term average. Government bonds didn't do so well. It essentially 0.07, and T-bills returned 1.87. The 1960s, of course, were a wild time. The social revolution took hold. So in 1960, the OPEC was formed. If you know what that is, it's the Organization of the Petroleum Exporting Countries. And in 1967, the U.S. Commerce Department reported that personal income had hit its highest level ever. And for this decade, stocks produced about 7.8% per year, government bonds 1.45%, and T-bills 3.88%. And the unemployment rate was just shy of 5%. And then in the 1970s, the energy crisis kicked off. I don't know if you remember that if you're old enough, but when I was a kid, cars would snake down through our neighborhood and we were far away from the fuel station. In 1975, unemployment reached 8.7%, the highest level since 1941. And in 1979, banks rose their prime interest rate to a record 15.7%. And if you look at the overall returns during this period, the stock market returned a little less than 6%, government bonds about 5.5%, and T-bills about 6%. Very unusual to see all 3 of those benchmarks return essentially the same return over such a long period of time. And then we're moving on to Reaganomics in the 1980s. One of the first things he did was sign a sweeping budget and tax cut. And in 1987, the Dow had one of its worst days in history up to that date. The market dropped 22.6% on October 19th. That was known as Black Monday. And later in the decade, President Bush signed legislation providing $166 billion over 10 years to bail out the savings and loan industry. I don't know if you remember that. I was a bank teller at the time, and I remember that. For the period of the 1980s, the stock market had a good time. It returned 17.5%. That's fantastic. Government bonds, 12.6%, also pretty darn good. And T-bills, 8.89%, also pretty amazing. We haven't seen that in a long time. And unemployment during that period was about 7.25%. Inflation was elevated throughout the period, with averaging in about 5%. And in the 1990s, we had the longest bull market in history. Some of the things that marked the decade: 1994, Republicans win both houses of Congress for the first time in 40 years. In 97, the Dow Jones Industrial Average experienced the single largest point loss ever to that point, and that was caused by the Asian financial crisis. And in 99, the Dow Jones Industrial Average jumped to its first close above 10,000. For the decade, it was another winner, with stocks returning over 18%, government bonds a little shy of 9%, T-bills a little shy of 5%, and unemployment during that time was a little less than 6%. Next, we have the 2000s. And right at the beginning, you might remember that after weeks of indecision, one of the closest presidential races in history ended with George W. Bush becoming president. In September of 2001, of course, we had the terrorist attacks on September 11th, very tumultuous event, not only for the nation, but also for the stock market. In 2002, the Dow Jones Industrial Average was down 3,381 points from its high watermark in 2000. In 2003, the war against Iraq created uncertainty throughout the Middle East, and at the same time, the markets turned higher. In 2007, subprime mortgage concerns resulted in a credit crunch, and then in 2008, we had the global economic recession, the Great Recession. And in 2009, the Dow bottomed out at 6,547 on March 9th, less than half of its peak in 2007, which was 14,164, a complete routing. Markets subsequently rallied as the government launched stimulus to help the economy for the population to get back on their feet. So looking at this decade, the S&P 500, negative 0.95. Long-term U.S. government bonds, about 7.7. T-bills, 2.76. So not a great decade for stock investors. I guess we're calling the 2010s the I generation. There was a record 2.9 million foreclosures in 2010, coupled with the fewest number of new home purchases in 47 years. Knock-on effects from the Great Recession. In 2010, the Fed used quantitative easing to help stimulate the economy as unemployment averaged above 9.5%. In 2011 and 12, concerns about the survival of the Eurozone came into play because Greece was teetering on the precipice of bankruptcy. And that fear sort of was a contagion throughout Europe, and they fell into recession. In 2014, the Fed tapers and ultimately ends their quantitative easing in the credit markets. And in 2015 to 2019, after 7 years of essentially a zero Fed funds rate, the Fed began raising rates, and it climbed up to about 2.5% by the end of 2018. And then they had 3 rate hikes in 2019. So a lot went on during that decade. And with it, the stocks had an above average performance, returning 13.5% per year. Long-term government bonds, about 6.5%, and T-bills, about 0.5%. Moving on to the 2020s, it's sort of a new normal. The first global pandemic in a century prompted a radical transformation of everyday life. Pre-pandemic shifts in consumer behavior, business practices, and the adoption of new technologies accelerated rapidly. Multiple waves of virus variants curtailed aspects of economic growth throughout the first 2 years of the decade. Massive central bank easing and government fiscal stimulus, however, supported most developed economies. The US recession that was spawned by the pandemic lasted just 2 months, the shortest on record. Both stocks and bonds broadly gained during the first 2 years of the decade. So looking at this decade, the performance of the stock market clocked in at 10%. That's very close to the long-term historical averages. Long-term government bonds, negative 10%. US Treasury bills, 2%. So we've gained a better perspective on economic trends by looking at some of the stock market's brightest and gloomiest moments. Let's look at the performance of some hypothetical asset allocation portfolios from January 1930 to December 2023. That's an extremely long period of time. It should give you an even better perspective on historical returns. Remember, when we were looking at the decades, some decades were up 19% and others, stocks were flat. So wide variations within the decades. But when you step back over this span of time, the aggressive growth portfolio returned almost 10%. The growth portfolio, 9.3%. Moderate growth, 8.5%. Conservative growth, 7.23%. And income, 6%. So if you had put $1,000 in any one of these portfolios, at the end of the period, your aggressive growth portfolio would be $7.2 million. That's $1,000 to $7.2 million. And even the most conservative investor would have come out with $266,000. That shows you the value of compounding over time. It's about time in the market is much better than market timing. And it's not to say there aren't reasons to want to get out of the market. Let's look at this mountain chart of the market. It highlights some of the worst things that have happened since 1970. Some just terrible events, the Oklahoma City bombing, the 9/11 terrorist attacks, Facebook was launched. But despite it all, the market keeps climbing higher. There's never been a time in the United States where the market has suffered a significant loss and not come back to achieve all-time highs. The key is time and being patient for it to happen. Looking at this one, this is just since 2008. And many of you are familiar with the events on this chart, but still, over this time, the market's returned over 500%.
So we want to summarize the presentation into 3 topics we discussed, beginning with emotions and how investors' emotions can sway their investment decisions. Expectations, as shown by the 3 investor types, the optimist, the skeptic, and the pessimist. Investors' expectations can lead to disappointment in the performance of their investments. In economics, our tour through the decades provided a historical picture of market performance. 5 action steps you can and should take today. Now that you have perspective on the stock market and how emotions affect investment decisions, you may have a few questions about your own portfolio. This bar graph details the max decline of the S&P 500 during a calendar year in orange and the total return for the entire year in blue. We want to leave this up for a second. This is our last slide of the presentation, but really highlight that in orange, each year there's an intra-year decline, some a lot worse than others. Looking at 1987, the S&P 500 was down negative 34% at one point during the calendar year and ended the total year from January 1st to December 31st, up 2%. More recently, negative 25% in 2022, and we didn't get back to positive. We stayed down negative 19. And this year, so far, we've gone down negative 10%, and we've hence recovered to the most recent quarter and at negative 5%. Thank you for attending this presentation, and feel free to contact us if you have any questions.